Good morning, venture capital. This is Metagame, and today's episode is about how the financial world is experiencing a seismic transformation as banking and investment platforms fundamentally reshape the way we interact with money and build wealth in the digital age. Everyone's chasing the next $5 billion AI mega round. Meanwhile, insurance just quietly posted 78 deals with 73% growth, and I'm starting to think most of this market is looking at the wrong scoreboard entirely. Let me paint you a picture. While venture Twitter was losing its collective mind over xAI's $5.3 billion raise and Databricks extending another $4 billion, something far more interesting was happening in the categories nobody puts on their podcast highlight reels: commercial banking, insurance, investing infrastructure, the unsexy stuff, the stuff that actually runs the financial system. And here's what that stuff did last quarter. Commercial banking surged 22% quarter over quarter. The investing category jumped 20%. But insurance? Insurance didn't just grow. Insurance dominated. 78 deals, 73% growth. That's not a rotation. That's a repositioning of institutional capital, and if you're not paying attention, you're about to miss the window. Now, why should you care about insurance deals when you could be tracking the latest foundation model drama? Because insurance carriers sit on something AI actually wants: massive workflow inefficiency, manual underwriting, legacy claims processing, agent-dependent distribution models that haven't fundamentally changed since your grandparents bought their first policy. AI can compress these workflows by orders of magnitude, and the carriers know it. Here's a number that should make you sit up. Sixfold, a Series B company, has processed over 1 million underwriting submissions representing $265 billion in gross written premium. That's not a pilot program. That's not a proof of concept collecting dust in some innovation lab. That's production deployment at carrier scale. And Guidewire, the incumbent policy administration platform, didn't just watch from the sidelines. They invested. When the legacy infrastructure vendors start buying their AI future instead of building it, that tells you everything about where this market is heading. But let's talk about the broader financial services picture, because insurance isn't operating in isolation. The Fed dropped a proposal in late February that's about to unlock 18 months of pent-up activity. They're formally proposing to remove reputation risk from supervisory frameworks. Translation for those who don't speak regulatory: banks can finally partner with fintechs, crypto platforms, and payments infrastructure without their compliance officers having panic attacks. The proposal explicitly states that Fed-supervised institutions shouldn't be encouraged or compelled to deny services based on constitutionally protected beliefs or involvement in politically disfavored but lawful activities. That's the debanking problem getting solved in writing. And when you solve debanking, you unlock deal flow in embedded lending infrastructure, sponsor bank middleware, compliance as a service platforms, all the picks and shovels plays that help regional banks participate in fintech ecosystems without building internal capabilities from scratch. Want to see what this looks like in practice? The Bancorp's Q4 earnings tell the whole story. They posted $643.6 million in year-over-year fintech loan growth. Their CEO described a business model where fintech loans earn fee income but have zero margin. Read that again. Banks are becoming platforms for fintech program distribution rather than pure spread lenders. That's not a minor adjustment to the banking playbook. That's a fundamental restructuring of how banks make money. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. Now let me give you the KPMG data that connects all of this to the AI story everyone's actually tracking. 26% of enterprises have deployed AI agents in production. Average AI budget per large enterprise, $124 million. And here's the kicker: 67% of companies plan to maintain AI investment through a recession. Financial services hits all three variables at scale. Insurance carriers, commercial banks, asset managers. They have high-value workflows where AI delivers measurable ROI. They have massive technology budgets concentrated at the C-level. And they have regulated business models with recession-resistant revenue streams. People still need insurance when GDP contracts. Banks still process transactions. Wealth managers still manage wealth. This isn't discretionary software spend that evaporates when CFOs get nervous. This is operational infrastructure that buyers will defend through downturns because the alternative is losing 500 basis points of combined ratio to competitors who moved first. The investing category's 20% jump deserves attention too. 54 deals versus 45 the prior quarter. And here's what's interesting. The Form D data is dominated by pooled investment funds, not venture-backed wealth platforms. But that's exactly the point. The opportunity isn't building another robo-advisor. The opportunity is selling into those multi-billion-dollar funds. Renaissance Institutional Equities filed at $28.2 billion. Medallion Fund at $26.3 billion. Bridgewater, Pure Alpha, combined across entities at another $26.3 billion. That's your customer base. That's who's buying data infrastructure, ESG analytics, AI-powered research tools. The pattern here is companies that look like software companies but capture fintech economics. Ramp raised $514 million in Q3 and another $312 million in Q4. It shows up in the other technology category because it's categorized as SaaS, but it's really financial infrastructure, with software margins and embedded financial services revenue. That combination commands premium valuations because you get the best of both worlds. So here's the strategic question that should be keeping allocators up at night. What's your exposure to regulatory-dependent categories? And how are you modeling regulatory recalibration as a portfolio accelerant? If you've been underweight financial services infrastructure because regulation makes everything slow, you might be missing the moment when regulation enables rather than constrains. The Fed's anti-debanking proposal. Basel III, endgame clarity expected by end of this month. These are exogenous catalysts that can unlock massive partnership activity. Your competitors with domain expertise are already deploying capital into suddenly unblocked categories. Sponsor bank middleware, crypto banking infrastructure, embedded lending platforms. They're capturing 12 to 18 months of market share lead while generalist funds are still updating their thesis decks. And if you're looking at insurance specifically, here's your diligence problem. Underwriting automation, claims processing AI, agent productivity tools require carrier validation that cannot be faked in a pitch deck. You need reference customers, production deployment metrics, loss ratio impact data. If your network doesn't include insurance carrier CTOs, actuaries, or distribution heads, you're flying blind. The good news? Insurance is large enough and fragmented enough that multiple winners can coexist, but only if they're solving real carrier problems rather than imagined ones. The Form D data is showing us exactly where institutional capital is flowing. Financial services infrastructure plays have defensible moats through regulatory compliance, data network effects, embedded distribution. They have predictable expansion economics through per user and per transaction pricing into high LTV enterprise customers. They have recession-resistant revenue streams because the underlying services are non-discretionary. Compare that to consumer fintech apps where customer acquisition costs are exploding and regulation is tightening. You're choosing the hard game over the easy one.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
So let me bring this back to where we started. Everyone's chasing the $5 billion AI mega rounds. The ones that make headlines. The ones that only sovereign wealth funds can actually write checks into. But the real alpha might be hiding in the $30 million to $200 million rounds, rebuilding the operating systems of commercial banks, asset managers, and insurance carriers. The unsexy stuff. The stuff that actually runs the financial system. Insurance posted 78 deals with 73% growth. Commercial banking surged 22%. The investing category jumped 20%. This isn't noise. This is institutional capital telling you exactly where it's repositioning. The question isn't whether financial services infrastructure matters. The question is whether you're positioned in the picks and shovels layer of the $202 billion AI boom, or whether you're still chasing consumer apps in overcrowded categories while the smart money quietly builds the future of finance. The scoreboard everyone's watching? That's last quarter's game. The scoreboard that matters, it's right here in the data, hiding in plain sight, waiting for the people paying attention to make their move. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.